All right, welcome back to another episode of Finance Agents Live. This is episode number 33. Episode 33. And
Jesus'
today...
age.
What?
That's how old Jesus is.
I did not know that.
Lived in Italy.
The
They'd
age
say,
that he...
How old are you? 33. Oh, the age of Jesus.
Okay, well, now we know something about Italy. They really... Okay, 33, Jesus' age. You just made this show that much more important. Now we know it's about Jesus and funding. All right, so today is a show where we talk about the rates and costs across a range of different funding programs. I got 9 different funding programs that we offer on a regular basis, and then there's some that are outside of that. But there's a million different things we could talk about, but there's only so much that we know well enough to give you the good rates and terms. So the people that really want to watch this show it's great for agents that are out there offering funding to people, but we made this show specifically for business owners or investors that are looking for capital, and we want to give you a general range of what are the rates and terms so you know if you're getting a good rate or not. Frankly, this is a very difficult answer to give you because there are so many factors. As you hear us say, this so much depends on the criteria and all the different factors for a client. So we're going to give general overviews. We'll do a quick run through on all the programs, and then we'll spend some time doing a little bit more of a deeper dive on each one. So if you're watching this, just say, hey, just give me the facts. Let me get the heck out of here. I'm going to do that first. These are the funding programs we're going to run through quickly, and then we'll go through in more detail for the people that like the deep dive. All right, so 9 funding programs we're going to talk about. First of all, retirement rollovers, 401k rollovers. What's the costs and fees for something like that? And then securities-backed loans. That's a loan if you have stocks and bonds and you want to use that as collateral. We're going to talk about business term loans, which would be anything from an SBA to a private business term loan, 1 to 3, 5, up to 20 years. We'll talk about personal loans that are available right now, private real estate loans, which we call our CRE program, a commercial real estate program. Talk about fix and flip financing, business credit cards, receivables factoring, and revenue-based advances. We're going to run the gamut today, and if you didn't, I guess you wouldn't know this, but that is in order of cheapest to not cheapest. I don't want to say most expensive. Just
we debated that. How you're
yeah, and you could reorganize these based on how you do it, but cheapest to least cheap. Perceived. And that's the order. You know what? If I was talking to somebody, this is the order I would ask questions for because I want to get people into the cheapest funding possible because that's a happy repeat customer, and so we're always looking for the cheapest thing we can. And so that is it. Let's jump into the quick overview. I know this is a lot to have on one page, and I apologize, but I'm going to try to do the quick run through, and then we'll go through in more depth. First of all, securities-backed loans. I put those, it's kind of a toss-up. What's cheaper between that and a 401k rollover? Depends on how much money you're getting a loan for. But basically, you're looking at a 2 to 4% interest rate. That's cheap. An origination fee ranges from 2 to 4%, and there is no service fee. So that's pretty darn cheap. The only thing is you got to have, say, $100,000 in stocks and bonds in the bank. All right, retirement rollovers. This is if you have you have money in a 401k, you want to use it to finance your business. There is no interest rate. That's the awesome thing. You are your own investor. There is no origination fee. There is a service fee, which ranges from $5,495 to $5,995. About a $500 difference depending on if you pay in advance or pay afterwards. Plus the 401k maintenance fees for as long as you have the 401k. Typically about $100 a month is what that comes out to. Next you have business term loans, and this is one of the reasons I brought Rhoda onto the show is that I've got a range here, and you're going to see stuff all over the place, and there's a lot of exceptions, so in the deep dive we'll go into a lot more detail on this. But interest rates are ranging from 7 to 22%. That's the range. Origination fees, you go around 6% is what you're probably going to be paying. And then there's a service fee if you do it through us, where we charge for another service and then throw in the loan. It's anywhere from $5 to $10,000, service fee, flat fee. All right, personal loans. If you want to get personal loans and you have personal income, we can go get a personal loan for you. The rates range anywhere from 6.25% to 32%. Again, a big range. We'll talk a little bit why there's such a big range there. Origination fee, some of these loans have no origination fee at all, some up to 2%. Some have a flat fee of $250. So it kind of ranges. And then a service fee, our service for helping people get that, is about 9.9%. All right, private real estate loans, another big range here. These loans, you can get them anywhere from 8.9% to 18.9%. Most of them are averaging from 12 to 15% is what I'm seeing. And origination fees, again, across all over the place, anywhere from 2% to 18%. You might be thinking, wow, that's a big range. Well, there is a big range, and I'll kind of talk about why. No service fees on top of that. All right, fix and flip loans, something we're starting to do a lot of through here. Interest rates range from 8.25% to 12%. You're not actually seeing anything outside of that. Origination fees from 2 to 5%, depending on states and a lot of different factors. No service fee. All right, business credit cards. We've done, hundreds of millions of dollars in business credit cards. People love them. And the rates on the cards range from 9.9% to 22.9%. Again, a big range. Most of them are coming in the 14 to 19% range. A lot of them come with intro promos with 0% for 6 months to a year. No origination fee on a credit card, of course. And if you have money on a credit card and you pay it off each month, you have no interest rate at all, because as long as you pay off your full balance, there's no cost. For our service, 9.9 to 11.9% origination service fee. All right, receivables factoring, we'll get into a little bit more detail what that is, but you're basically, whatever you're borrowing, you're going to pay 1 to 4% that per month. Most of the time, it's 2% per month. And again, we're going to get into more details. I don't have an origination fee. Is there an origination fee on the receivables factoring?
No, I don't think so.
Nope. All right, and service fee ranges up to 2%. Sometimes there's none. Sometimes it depends on where we go and what you're getting. And last but not least, really last but most, right, is revenue-based advances, which pays on a factor, not to be confused with factoring. What that means is it says a 1.12 to 1.5, and there's people that charge more than that, but what that means is if you borrow $100, you're going to pay back 112 to 150. 1.12 is basically a 12% amount, but it's not 12% annual because it could be in 3 months, could be 36 months. It really depends on the lender you're with. Origination fees have started really going up in the last year.
For those higher risk clients,
yeah,
for sure.
It used to be 2% is what I saw all the time. Now, some people are getting up to 12% origination fee, and we'll talk about that in a little more detail as well, and with no service fee. All right, so that was a marathon blitz run through. I hope I didn't put you to sleep, and I'm sorry you had to listen to me the whole time. I'll try to get the lovely Rhoda talking a little bit more on the show. But all right, let's go into 401k rollovers. I definitely want to say, if you got questions, hit them in the box, because let's have them focused around cost or the investment, or however you want to position what it is. But what is the cost in order to get the funding? And so, all right, so feel free to put it in the box and we'll answer. So let's do a deep dive on 401k rollovers. Now, you don't do the 401k rollovers, but you've seen some go through, right?
Mm-hmm. Yep.
We kind of did a back and forth before the show on what's cheaper, 401k rollover or a securities-backed loan. Mm-hmm. And what do you think is cheaper, right? Your securities-backed, you got up a 3% origination and a 3% APR, or 401k where it's $54.95 to $59.95 and $100 a month. How would you determine which one's cheaper?
Well, I guess it would depend also if this is a flat fee. So if you are rolling over $500,000 or $1 million, this is probably going to be cheaper because all of the costs are fixed. It's not a percentage. But if you're doing something on a percentage basis, if you're doing 3% interest on $1 million, that can get more.
Exactly. We see some people come in and roll over as little as $50,000. We help people get as low as $35,000. And if that's the case, then those setup costs look expensive. But there are some things you get with a setup that you wouldn't normally be expecting. Like, for example, they do an incorporation for you if you don't have a corp already. So, some people go out and spend as much as $3,500 just to incorporate. So this is baked into that cost, and you save money that way. And then the monthly fees. It used to be an annual fee. We're getting some feedback. You need to kick it up a notch.
Thank you.
There used to be an annual fee of $1,000 for the 401k management. I think they've now changed it to a monthly fee of $100 just to make it easier so people didn't have $1,000 bill come at the end of the year. But let's talk about that a little bit. You could look at it as the cost of the financing, but it's really more than that, right? So this is the cost to have and manage a 401k in your business. Now, there's benefits to this besides just the funding. That means, you bring on staff. They now have a 401k. It's an extra benefit. It's probably the cheapest benefit you can ever offer to your staff. Well, I say probably. When I've run businesses for 10 years now, and the cheapest benefit I see. Heck, man, we almost spend that much on coffee, right? So if you consider coffee a benefit, we drink a lot of coffee here. Probably not $100, but you get the idea. It's close to the cheapest benefit you ever. If you look at health insurance, you're gonna be paying a lot of money. You look at extra time off, vacation time, bonuses. What other perks? Food. Everything costs more than $100 a month. So it's the cheapest benefit. So it's an extra thing I just wanted to throw in there. All right, if we don't have any questions on the 401k rollover, let's move on to securities-backed loans. Darren, if you don't mind, you went on past the slide where I can read what we're talking about. Okay, securities-backed loans you're going to see a bit of a range on what we're talking about. But again, securities-backed loan is for someone who has $100,000 or more in stocks, or I think you can do it as little as $80,000 in bonds in an investment account. What the process is, you roll the money into a new investment account managed by the lender, and then they lend you money based on your portfolio. You don't have to sell your stocks. You don't have to sell your bonds. If you got $100,000 in stocks, you could typically get maybe $70,000 loan, and there's an origination fee and an interest fee. There's no service fee from us, and it's pretty darn cheap, right? The only thing is you got to have the money in there. But you know, if you got $1 million, you're paying 3% a year with, say, a 3% origination, which is kind of where I see it shake out the most. That's, what, a $30,000 setup fee and $30,000 a year, right? Darren's looking at me funny, like, it was scary on the quick math, but it sounds like a lot. But for $1 million, you could do a lot with $1 million, right? For example, you could take that money and invest it into Earn 11, make an 11% return, and your cost of funds is 3%. You're netting 11%, right? Or if your business, hopefully your business is bringing back a 20, 30, 40% per year gross, you can make a lot more money investing it than you're probably making in the stock market. In fact, if you're watching this right now and you're thinking, hey, my stocks are awesome because we're on the end of a 10-year run, I see at the end, it's going to turn sooner or later. We all know what goes up always comes down. If you've been through a few cycles, you know that.
Except your age.
Except your age. So, you know, it's gonna turn. Okay, moving on. Next. Again, if we don't have any questions, we'll just keep on trucking. All right, business term loans. This one we're going to talk about a little bit because there is a lot of variability. So why don't you explain what they're looking at and explain some of the variations on term loans.
When we start with the interest rate, there are a couple different types of term loans. Term loan, here we're talking more broadly about a loan that's probably 2 years or more. Generally, people, when they talk about term loans, they're talking about an SBA, which is 5, more commonly 10 years, or if real estate is involved, it's 25 years. And the interest rate there varies with Wall Street Journal Prime. And so it'll be that plus probably 2 3/4. So right now I think it's 4.5. And then the interest rate from some of those private lenders, that can go higher up to as much as 20%. And so that's why there's such a range there.
Right, okay, so 7 to 22% is a big range. So right now if you got an SBA, assuming the market doesn't change, which it is changing, right? We have inflation, right. That means interest rates are going to go up, but assuming it didn't go up, you'd be looking at 7.25%.
Right.
Right? Is there a lot of variation between the types of SBA loans, or is it just 7.25%?
There are a few different lenders that will have a larger margin on that, but generally what we see is about 2 3/4 on the term loans.
Okay. So it doesn't matter which bank you go through, the SBA rates are always the same. Is that true? Because there's a lot of banks you can get an SBA loan through. Does
right,
it vary?
It just depends on the ones we work with are about 2 3/4. Some may go higher, but right now it's just that Wall Street Journal Prime plus whatever their spread is.
Okay. And so when you get away from SBA and you start getting to regular bank term loans, what's the jump? What's the lowest non-SBA term loan?
I actually saw an SBA the other day that was 11%, and I don't know how they're doing that. I thought that it was more regulated than that. But the term loans that we've worked through are with not banks. I'm talking about private lenders. Yeah. So
okay.
Those are the 22%, 18%. But a bank term loan can be what they want. Usually I've seen them maybe 10, 11%. But
10 or 11?
Yeah.
For the bank? For the non-bank private term loans? Because I feel like I'm seeing them at 18 all the time. I've seen them more. I've seen them up to 22. No? I mean, you're doing it more than me.
I
stumped you.
when I go to a bank, it's for an SBA because they do want the extra security. So unless it's collateralized some other way, I don't really.
Yeah, some of the private term loan lenders, we've run into issues where somebody has an SBA loan at a great rate and they want to get more money, and the SBA is not going to issue a second loan typically on the same business. So they got to go to a private lender. The private lender is going to make them pay off the first loan, and now they're paying off a 7% loan with an 18% loan, and that is difficult. That tends to be a roadblock for a lot of business owners. But yeah, if you can get into an SBA loan, it's definitely the best rate. The banks do term loans outside of SBA, but now you're starting to get higher and higher criteria. It starts to get really difficult. And typically, if you qualify for that, you're not talking to us because your bank is actively offering you the financing as opposed to you looking for it. That's my experience. But what about origination fees? What kind of origination fees are we seeing?
Usually they'll have the origination fees. Again, this is for an SBA. The bank will have their origination fees, which can be a flat fee of about $2,500 for those loans about $150,000 or less for the Express, or it can be higher for the $350,000, and then there's the SBA guarantee, which is about 2 to 3 3/4 depending on the funding amount.
All right, so you've got our service fee, the bank's origination fee, the SBA guarantee fee, and the interest rate. There's actually 4 different things. In general, the SBA guarantee and the lender origination is 6%, right?
As a rule of thumb.
But you see it being less than that, ever?
No.
I mean, there was a while there where they were waiving the SBA guarantee fee, but it's not waived right now. It hasn't been waived for years.
And that's a good point. Veterans can often get that waived, or something like that. You can get that waived.
Okay, all right, good to know. Okay, so if there's no questions about that, we'll go ahead and move on to the personal loans. Personal loans is something we started offering a lot recently because people love them because they fund really quickly. But the personal loan, and I'm giving you a big range here, and some people may see this and say, "Ooh, I don't want that." But really, the personal loans we're offering do not tend to be that high. They're ranging anywhere from 6.9 to 32%. But really, our clients, I haven't seen anybody getting over 18%, and most of them are around 14 or 10. So the rates actually tend to be pretty good. They are personal loans. They show up on your personal credit, and nobody's really super excited about that. But you can get them for startups. It has nothing to do with the business at all. So if you have good credit and cash flow, you can get a personal loan. Origination fee is going to range depending on the lender. Some of them don't charge any origination fee at all. Some of them charge, I've seen ones where it's $250. I've seen the maximum I've seen is a 2% origination fee on the amount of funding. Again, it depends on the lender, and these rates may change. This is one of the things where this is one of the ones we see change more than some of the other ones. So this could be some fluctuation, but that's what you're looking at. If you come to us for the service, we charge a 9.9% origination fee. That's our cost. It's a service fee in order to get the funding for you. And I do have some people say, well, I can just go to the banks and get them on my own. It sounds easier than it is. A lot of these financing, it's a crapshoot if you go on your own to get them. So if you may be looking at our fees and say, hey, I'm spending more on your fees than I am on the lender fees, well, you're more than welcome to try to do it on your own. Just don't try too many times. Once you rack up a bunch of inquiries, then it's going to be difficult for us to help you. So the less you got going on with you when you come to us, the more likely we can help you. Okay, private real estate loans. Here is this is the single thing that I think fluctuates the most based on the lender, and I think we got the wrong rate on the slide. So I apologize for that. This is 7 to 22%, but I haven't seen one that's 7. These are private real estate loans. The lowest I've seen is, I'm trying to think, 9? I think I've seen one at 9%. This program is one of the reasons I did this show, because a lot of people have an idea on what is a normal interest rate for a mortgage. And they think it's, 4-5%. Right? They may think that's what's normal. Well, if you have an owner-occupied, conforming mortgage where you're buying it to live in yourself, you can get some amazing rates from these lenders that are doing these 30-year terms. I mean, heck, I literally right now, my mortgage is at 3.0%. All right, so that is, thanks. Yeah, I know, I'm pretty happy about that. I got it 4 years ago. So that is an amazing rate, but that is not private real estate loans. All right, you have to forget about that when you get into private real estate loans. You're going to pay more if your credit isn't qualifying or you don't have the income documentation that the banks require for conforming loans, or all the other myriad reasons. Maybe you're not a U.S. citizen, or you don't have. There's a lot of different reasons you don't qualify for a regular bank loan. My favorite example is I had a buddy of mine who's a dentist who sold his dental practice after working there for 20 plus years, had $1.3 million in the bank, but at that moment had no income. He had just started a new practice, which hadn't been around for 2 years, so the banks discredited any income that comes from it. And he tries to get a loan to buy an investment property. He has $1.3 million in the bank, and the investment property is $1.1 million. He could literally buy the thing cash, but could not get a conforming loan through the banks because he didn't have income. So we were able to get him a loan, about 50% LTV. I think that was the one, maybe it was around 8%. So I take that back, 8.5%. But that's an example of somebody who doesn't qualify for conforming rates, but he got a short-term loan. He refied it after a while once the new practice income had gone up, and it makes sense. So interest rates, origination fees, again, are all over the board, especially if it's a small loan. If you're coming in for a loan of 50 grand, you might pay 10, 15% origination. You might think, wow, why would somebody pay that much? It's because they're using the money for business purposes. It makes sense. And the lenders, these private investors, they have the same costs on a $50,000 loan as a $1 million loan, and they got to be covered. And that's what the origination fees are for.
Do the interest rates vary if it's a commercial property or a single-family residence, or why is there the variability?
Yeah, if it's commercial property, if it's raw land, if it's really rural, if it's a single-purpose building like a church with a steeple on it, those are difficult to foreclose on. That's how the investors are looking at these deals. The more negative factors you have, and credit, right? So we can lend to just about anybody. We have a lot of people that have gotten loans where their FICO score is under 500, which is an incredible thing to say, really. If you don't know, it really is an incredible number. But they're going to pay higher rates. They can get a loan, but they're going to pay higher rates. So those are some of the reasons for that variability. Good question.
Thanks.
And no service fees from us. All right, so next we're going to talk about fix and flip financing. Fix and flip financing has really heated up over the last few years because just like the stock market, the real estate's on a 10-year run, which is a good news because it had quite a hit about 10 years ago. So fix and flip financing is a tighter range. You're looking at 8.25% to 12% interest rate, 8.25% in some of the states like California where it's hyper competitive, 12% in some of the other states like the Dakotas where it's so rural it's hard to get financing at all, and a 2 to 5% origination fee. You're not ever going to see no origination fee at all. Fix and flip is construction financing, so this also qualifies for construction financing.
Is that only for residences, or if you find like a big box that's gone out of business, an old Blockbuster, can you use that for this program?
Big box, a lot of big box real estate coming on the market, so you might get a little investor trepidation with that one. But it does vary. I'm trying to think. You know what? Fix and flip is a lot more residential than commercial, but we do have commercial financing. The commercial does tend to be a little bit higher always. Commercial is always going to be a little bit higher. The origination fees are going to be a little bit higher. The appraisal is going to cost more. But if you're looking at buying a $2 million property, you expect to be able to, if you can't pay those fees, you probably shouldn't be buying it anyway. And that's kind of how the lenders look at it. All right, so great question. Somebody's asking what kind of properties fall under real estate loans. We sort of kind of answered that, but we're talking about private real estate loans. I'll hit private real estate loans and fix and flip. I think I kind of answered that, but it'd be residential properties, non-owner occupied. We do nothing owner occupied. Well, there's some small exceptions to that, but no reason to even get into it. Private real estate, so single family properties, commercial properties. We do some raw land, but those are going to have real low loan to values. The construction would fall under the fix and flip category. Pretty much anything. Single purpose buildings are harder. We had somebody come to us, they wanted to get a loan on a mortuary with a graveyard. Ooh, that one's tough, right? Hard to think you're going to use that for anything else. So that's one of those things that would be real hard to foreclose and sell off for the investor to regain their capital should something bad happen.
The 21-year-old me, the goth, is like, that'd be a cool dance club, but I don't I just couldn't imagine all these goths be like, yeah, let's
I'm
go to
trying to
the
imagine
mortuary.
you goth now. You're going from hearts on the pants to goth.
I wasn't goth, but that was very popular when I was younger, and then,
Now you're goth.
It's a good idea.
On the weekends. All right. Cool.
Right? It's still popular.
Okay, great. A lot of goth around here. Yeah, well. All right, moving on. Business credit cards.
I think this is the one where we're like, oh, is this one really cheaper?
Okay, so the business credit card is one of the ones we argued about on where should it be in the mix, right? For example, if you look at the origination fee with us, 9.9 to 11.9%, that may seem like a lot. Then again, a lot of the cards comes with a 0% promo, so that's sort of, you're sort of paying the year's interest. You pay from the cards. But if you have these cards for 30 years and you spread that cost across having this available capital for the life of your business, that cost starts to become really minor. Plus, if you pay off your cards every month, you have no interest fee at all, and there's no origination fee each time you use it. So this could potentially be the cheapest type of financing you have. I've got a question from the audience. All right. How does the exit strategy on a fix and flip sell with a buyer in place, rent investment property, or keep for your... you lost me. What's the exit strategy for your own affect interest rates on the loan? I think what you're asking is, does the different exit strategy you have affect the interest rate you're going to get on fix and flip? And I'm going to say no. They don't care about the exit strategy. They care more about what type of property is, what's the loan to value, and what's the after repair value when you're going to be building it up. Also really comes down to which investor we go to. Some investors land in different states, but the exit strategy is not a prime factor in cost.
It's mostly flip. It's mostly sell, right? It's not a fix and hold. It's a flip. So just selling it. We call it the
fix and flip program, but it's also construction. And some people are looking to their exit strategy is to get a secondary construction financing afterwards, or maybe they want to buy and hold, and that's okay as long as the after repair value justifies it. So I'm going to say no. That does not affect the cost. And if I'm wrong, I'll type it in the notes afterwards, but pretty sure that does not affect it. All right, so business credit cards, you have anywhere from 9.9 to 22.9% interest rate. Most of them are falling in the 14 to 18% range these days. They've come up over the last 5 years. It used to be a lot less, but this is where banks are making most of their money these days, frankly, on business credit cards because they're awesome. People love them. They're great for startups. They're great for everything we said about. There's a lot of reasons you don't have to pay anything at all for the cards because you just pay off the cards each month and you have no interest fees. All right, receivables factoring. Why don't you talk about receivables factoring a little bit?
Yeah, this is really great for people who probably, I'm working with a guy right now, his credit's a little challenged because he put a lot of things off while his business was getting going, and now he's kind of starting to reap the rewards of that. He's getting some bigger contracts and he's invoiced a lot, but now he needs more money to grow the business, and so factoring is a great option for him. The factoring, depending on the different company, they'll do about 1% a week or 0.5% a week to a monthly charged, and it's based on your AR. That's about how much they charge, and then our service fees are about 2%.
All right, so making sure you understand exactly what that is. If you running a business and you have an accounts receivable, meaning people owe you about $100,000 right now. All right, so maybe each month your AR, your accounts receivable, is about $100,000, for example. So you would go to an AR financing company. They would give you like $70,000.
Yeah.
About 70% of your accounts receivable. And then the people that owe you money don't pay you, they pay the company. And you end up getting all of the money minus generally allow about 2% of 70%. Right?
They'll advance you the remaining 30%. I'm not quite sure I follow you, so I'll try and rephrase
$100,000, you get $70,000.
They'll give you the 30% remaining once they get paid, minus the fees. If for some reason your
and the fees
client,
are if it's 2% of what? 2% of $70,000?
Sorry, the
or 2%
interest
of
per
$100,000?
month. That's their interest or whatever they're charging you is the 1%. So they'll net you the rest of the money minus that cost. So if you have an invoice that's outstanding for 30 days or 60 days or 90 days, it's going to change the percentage.
Right, but let's hit it again. So it's $100,000 in accounts receivable. Mm-hmm. They give you about 70% of that. They give you a loan for $70,000. Mm-hmm. And let's say it's 2% per month. Is it 2% of $70,000 or 2% of $100,000? I think it's 2% of 100.
I believe you.
Okay, so 2% of your entire AR, not just the amount that was advanced to you.
What?
All right. And then there's up to a 2% service charge. It really depends on the lender we go with and your situation, as we said otherwise. But yeah, that's what you're looking at. So we get another question coming in. All right. Hank? I just almost called you Honk. That's about the funniest mispronunciation I've ever done. Hank is asking, client has a contract with funds escrowed for $250,000 for a transaction that will close in 30 to 90 days. What approach would be best for him? Is the contract valuable as collateral? All right, so let me talk through this and make sure I understand. Client has a contract. It sounds like a business. This is a purchase. This is like purchase order financing, right? So somebody's going to pay $250,000 for a product from this client. Tell me if this is real estate, because it would be different. Typically, you're using escrow in real estate, not in a business that's selling widgets, but I think this is widgets. So let's say client is selling $250,000 in widgets. The person wanting financing is selling $250,000 in widgets, and somebody else has put the $250,000 in the bank in an escrow account already, ready to pay. I'm going to go as far as to say no. That's going to be really difficult to collateralize because probably there's a lot of covenants on the escrowed funds that certain things have to have happened. And since the lender they want real security and they don't know if the borrower is actually going to do these things, that's going to be a really difficult thing to finance. That's an excellent question. But maybe depending on the type of thing it is, there could be exceptions. But in general, I don't know anywhere to take something like that. It would be one of those wild goose chases that we get a lot of, right? That would be a difficult thing to finance for that one reason. The lender's going to say, well, what if this guy doesn't deliver the widgets? And you say, well, he can personally guarantee it. Most people that come in for, this kind of sounds like purchase order financing, most people that come in for that end up getting receivables factoring. So what we do is say, okay, we can't do it on the contract, but let's look at the rest of your business and do the financing based on that. And normally, if somebody has money in escrow, they have a good business that's generating other revenue. It's probably not their only $250,000. So normally, there is something we can do for them. It's just not going to be exactly like you were saying. Now, the purchase order can help, but you're not going to be able to base it solely on that. Let me know if that didn't answer your question, but I think that should. All right, so moving on, last but not least, because it's last but most, is the revenue-based advance. This is something that Rhoda knows a lot about because we finance these internally. So when you talk about factor and what a factor is and what kind of rates people see.
So with a revenue-based advance, it's a factor. It's not an interest rate because the cost of the loan happens or advance happens right at the time of funding. It's not spread out over time. So if you borrow $100, to keep math simple for me, you'll pay back $112 or $150, and that depends on the term of the loan or advance. So you could have a 1.5 for 3 months, or you could have a 1.5 for a year. So that depends, that can impact your cost as well. So if you have a 1.5 for 3 months, your interest rate would be really expensive, but if it's a 1.5 for a year, then that's much cheaper.
Well, that's the thing, in a way this is the easiest program to figure out the cost, but she says that the cost changes. Well, the cost doesn't change, the interest rate changes based on how much time that's spread over. But the cost is fairly simple to calculate. And one of the reasons that this is last is that cost is fixed, meaning if something magical happens and you can pay it back in 30 days instead of a year, you still got to pay the whole darn thing. You're not getting some sort of a discount unless you ask for it in advance. And most people don't ask for it. So you're paying the whole thing even if you pay it quickly, which is unlike most other types of financing where if you pay it off early, you're just paying off the principal and not the interest for the entire term, right?
Right.
Now, let's talk about this origination fee, because frankly, I was shocked when you told me that people are paying up to 12% origination fee. What are you seeing most? This is really a change within the last year, right?
Right, and some lenders are doing it differently because as the industry has changed, as you know, lenders are just getting so much more aggressive, and people who normally didn't qualify for an advance are now being able to get 4th, 5th, 6th position advances, and those are when you're going to see the higher origination fees, and that will be determined when they verify the bank accounts. The underwriter will go in, do an electronic verification of the accounts, and a stronger account may have an 8% origination fee, but weaker banks will have a 12% origination fee. The top tier, the A tier paper, B tier paper is probably going to see the 2.5%, 3% origination fees, but it's all based on risk.
So if I'm a business owner and I get a 1.3 factor, how do I know if I'm getting a good rate or not?
What are you doing with the money?
Stuff.
How much are you going to make on it?
Does it matter what I'm doing with the
Well,
money?
it's just what are you going to make on it? Are you going to make more than the 1.3? And do you qualify elsewhere? I mean,
all right, so that's, you're talking through, what am I going to use the funds for? Does it make sense to take the loan?
Right.
But how do I know, if I'm talking to 3 different people, how do I know I'm getting a good rate? Or maybe I should keep shopping. How do I determine that?
What are your other options? Exactly. Like if you only qualify for this and you're getting a 1.3 for 6 months, is that important to you? Or are you getting a 1.4 for 8 months and looking at your daily costs? This is, I think, also a hard program to understand what is the person's pain point. Is it the daily payment? Is that cheaper, but you're going to pay more over term? Because let's say you have a 1.4 for 12 months, it's more expensive than a 1.3 at 6 months, but your daily payment's going to be more. So it depends on how you see the cost.
All right, so let's say I wanted to get a 1.2 factor. What would I need to qualify for a much lower rate? Or what's the lowest rates you're seeing these days?
For 1.2, you'd have to have probably a restaurant or something that really cash flows every day with a 700 FICO.
Okay, so FICO matters, daily payments matter. Is it the volume of money? I mean, do you have to be doing $1 million a year to get a lower factor, or?
I don't know that I've noticed that. 25,000 probably a month would be a good to get up to those A-tier lenders. They want to see higher deposits for sure. Consistent deposits every month. You have 25,000 with 10 plus deposits a month. That's helpful too.
Okay, so consistent deposits, lots of payments, good personal credit score, and probably good business score, and that's how you get the lower rates. Mm-hmm. And what are you seeing? What's the lowest rate you've seen, like in the last month?
Probably a 1.38.
1.38. All right, that's much more than what I was saying. So if I got a 1.3, I should be dancing in the streets. That's a good rate. Mm-hmm. Okay. All right, dancing in the streets. That's what.
But for how long?
All right.
3 months or a year?
Okay. There it is. All right, so that's
I
don't know. All right, so that's really it for the show. I mean, feel free to ask more questions if you got them, but that's a run through on all the different funding programs. What, you got something to chime in?
Who won your book?
Nobody answered the damn question.
You got to answer the question.
If you have a business story where you overcame some sort of a hurdle, but you had difficulties in the business, we still want to hear about it. You go back and find the show, Crednext Challenge 2. And then go from there. So Deepak is asking if it costs so much, why don't they just do UBF, which is why don't they just get business credit cards? Well, there's reasons. I mean, you can have a 700 FICO score and still not qualify for the business credit cards. Or the business credit cards could take, say, 2, 3, 4 weeks. You can get a working capital, cash advance, revenue-based advance in 2 or 3 days sometimes. So if you need money fast, if you're going to miss payroll, you don't want to lose all your employees, or you got a really hot opportunity where you need the capital quickly, often it's worth the cost.
Also, these funds are really flexible for a cash advance. With UBF, the person has to take credit cards, and this is really just a lump sum payment. So there is a liquidation fee with UBF, and that can be annoying for people.
Yeah, I mean, in general, the credit cards are going to be cheaper. There's just a lot of reasons why people don't qualify, and it will potentially take longer. So those are some of the reasons. But yeah, if they qualify, great. That'd be a great option for them.
Yeah. Remember, we had a pharmacist who did an RBA, and he had to get the money quickly because he wanted to purchase another pharmacy, and had like a week or something in between his ability to purchase it and the end of that purchase. Mm-hmm. So
right. I think that pharmacist was also international. From Canada, didn't have a U.S. credit score, wasn't able to qualify for financing that way too. So anyway, a lot of different factors, a lot of reasons why you don't qualify for traditional financing, and that's when these other alternative programs really shine. Even though the cost is high, if it's less than what the value is to the person, that's really how you determine whether or not it makes sense for you. but also just the cost range. That's a good idea. So 1.38 for a year, or what?
I like it. I like that deal.
You like that deal?
That's a good deal.
All right, good. Well, we'll go ahead and wrap it up today. Thanks everybody for coming on the show. Come back next week for what are we doing next week? We're still waiting for a confirmation.
Bankers Group.
Are we? Yeah, we haven't got a confirmation yet. We're trying to get a real live banker to come in here so we can pepper them with questions for the people that are going out to banks asking for their turndowns, which is an incredible way to generate funding opportunities. We're trying to wrangle one of our banker buddies to come in here, sit here, and have us pepper them with questions about what it's like on the other end when people come and ask them questions. So we're shooting for that next week. 2 weeks from now, we're going to be talking about the retirement rollover product that I mentioned on this. If you have retirement funds and you want to know if you can use them, heck, just give us a call. But if you want to wait 2 weeks, we're going to do a whole show on it. We're going to have Ben Morris, the founder of your funding team, in here with us to talk, or retirement processing, to talk about how that program works for you. So thanks everybody for coming on the show. If it's your first time here, subscribe so you get all our juicy details, all our hot funding opportunities.
Hot gossip.
Well, no gossip. You got any gossip to throw in? I don't think so. All right, thanks for coming on the show. We look forward to doing a lot more deals together. I think